Similarly to example number one, we've essentially swept the liquidity of the prior high and then traded back lower, and then price impulsively moves to the upside, breaks and closes above, which we denote as the true break of structure. Now, if we look at the third and final type of identifying structure, we'll be using the candle wicks, and we'll be identifying the market structure breaks using candle wicks as well. So if we look at this example, we can see, like example number two and number one, price moves to the upside. We use the highest wick as our high, and then price trades down. What we can see then is price then spikes the high, which we would denote as a higher high in this overall structure, because this high is higher than this high. And then what we can see is price then begins to trade lower. It breaks the prior low, which then forms a lower low. So our lower high would be this particular area right here. So when price then moves to the upside, impulsively breaking above this high, we would denote that this is the higher high. So when we're comparing this version to the previous two, we can see that this one factors in all of the subtle movements of liquidity that are happening within this overall trading range. Now, I think the biggest thing to stress is that whichever method that you choose is ultimately up to what makes the most sense to you, and I cannot stress how important it is to consistently apply that method across. You can't be using method number one day, then method number two another day, then method number three another day, and expecting for things to work. But with that said, mapping out market structure and identifying breaks of market structure is really just a framework of how we view trades and how we're setting up to understand an overall sentiment of the market. So for example, if we see prices making higher highs and higher lows, it would make sense to be entering buy positions. And if price is making lower lows and lower highs, we'd be wanting to take sell positions. So we'd be trading in that direction, but we're not actually trading the market structure in its true form. We're going to be focusing more on order blocks, inefficiency, and Wyckoff. So basically, the market structure is just that overall framework to understand where momentum is likely to occur and which direction that we're ultimately trading in, so that we can frame our trades in the highest and most probabilistic manner possible. And what we can see amongst all three is they're all very similar in nature. They all come to the same endpoint, saying that price is moving upwards, we break structure, and we're creating higher highs. The only clear delineation between the first two is the body versus the wick, but the market structure break is both dependent on a break and close above structure with a body. Now, one key thing to note when we're looking at TradingView data, broker data, is that from one brokerage to another, or one data feed that you're using on TradingView, for instance, Owanda versus FXCM, what you'll notice is wicks will differ. And why does that happen? So each broker uses different data feeds, which has access to slightly different liquidity pools and fills. So essentially, when you are trading with a brokerage, your spreads tend to increase or decrease depending on volatility and market conditions. And you can usually see that on a chart in the form of wicks. But if you're comparing the overall price action between one data provider and another, the one thing that generally speaking remains very true are the candle bodies, which is why method one has relevance. You'll see a little bit of a difference when you're mapping out wicks. If you're looking at one broker, this wick may be in the place that it's denoted, but on another broker, it might be actually above here, which is why when you're looking at method number three, you can get a lot of differences from brokerage to brokerage. And another thing to note on method number three is this can be confusing if you're not understanding what's truly happening on the bigger picture, because as you can see, we are in an uptrend till this point, and then we start in a downtrend. And if you're not careful, you might be trying to look for the lower high to essentially catch the lower low. So regardless of which method that you are choosing, you always have to ask yourself, what happens after we break structure?